Hey folks, welcome back to this edition of Ben's Bits. Last week we continued discussing inflation and its effect on someone's portfolio, more particularly how it affects the net worth. And if you haven't gotten a chance to view that, we're going to be continuing on that topic. So you may want to view that video as well because we're discussing how it affects your portfolio, whether you're building the portfolio from the ground up or preparing for retirement. Again, it really doesn't matter because inflation affects the value of the portfolio and really might put you kind of backed up against the wall because you have to replenish the capital that's lost in order to be able to outlive your account. And I also wanted to specify that it's not all doom and gloom because if you're smart with your approach and really think about any or particular investment and what it's doing and how it relates to what the objective that you want to accomplish, you can prepare for contingencies along the way. So I guess that was a fancy way of saying you want to be aware of what the market is doing, but be specific in how you approach investing and certainly not be lulled into analysis paralysis moments because that's certainly going to be a factor in moving forward, right? So this week we're continuing on the topic of inflation because it's real, folks. You know, we're hearing a lot of people saying that they're struggling to keep up with the Joneses because their money doesn't go as far today as it did yesterday or the day before that, not to mention their portfolios seeing massive declines. And we're hearing that investors, really people in general, are seeing the effect in real time almost daily, which is why we've been so adamant about being strategic with your investment vehicles of choice. I'm sure most of you have seen the global financial asset portfolio chart and the data that shows that there's been almost $35 trillion in global market value that's been erased just since the beginning of this year. And we're only about halfway through Q2, folks. So that equates to 14% of the global wealth that's been erased from the books, which, by the way, includes the $1 trillion in crypto losses over the past few weeks. So, folks, remember, if you go back to your history books, there was in 2008, that was a 19% decline. So we're really close to those kind of numbers. And a question that we've been getting asked a lot lately is how does that fit into BlackRock, Black Knight, and other hedge fund types buying up all the homes across the country? Because they're a huge outfit and, are too big to fail, wink, wink, right? Being a little tongue-in-cheek, but they're a huge fund that can afford to have massive losses because of how they operate. But even they're feeling the pain over the last couple of weeks. So if we visit this for a moment and give context, and let's just say that I was BlackRock and ETF funds or companies like them. Listen, folks, people don't comprehend this about hedge funds and how they operate. But let's just say I'm BlackRock and I'm managing that money. Whatever they purchase, they are securing, quote unquote, assets for you, and they buy something with your money. Let's say a certain stock, and you own shares of that particular company that they buy for you. So they're essentially in control of where your money goes, whether or not you agree with where that money goes. And listen, there's a lot of people giving these big hedge funds their hard-earned capital to manage because those firms are more economical and investors want to save their money and not pay a fee. That's the question we've been asking. Do I give it to a money management or do I give it to these other bigger companies that don't charge for the money? So we hear it all the time. They say, listen, I don't want to pay someone a management fee. So I'm just going to go buy through a hedge fund through, say, BlackRock because they don't charge me any money. They charge me zero. Well, if you read the fine print and the documents, because they give you the performance of the portfolio. So according to the very fine details laid out in the small print, They can take your capital and not purchase the stock. And by the way, you don't know when or if they're going to buy them because it's baked in on the documents that they can replicate, and they do it synthetically through derivatives. Now, before we get too off track, now it happens. If that happens and you abdicate that responsibility to BlackRock, do you as the investor want the market to go up or down if you're the buyer? Well, BlackRock wants the market to move, say 3 percentage points, because they're using your capital to make money, just like the banks do. But you're sitting there thinking that you're paying zero. So they make money either way with your capital, while you make nothing and take in all the risk. And that's just how it works. So how is that working out for you if you're involved in that investment? So that's it for this edition of Ben's Bits. And as always, thanks for watching, and we'll see you next time.